Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Chan, you're watching Indian Open. Let's go straight to the headlines. Retail inflation in India rose to 3.99% in September. That's the highest since July 2018 and higher than the Bloomberg poll of 3.8%. Hindustan Unilever reported a volume growth of 5% in the second quarter, in line with analyst estimates. Lower tax expenses boosted the company's bottom line. The Reserve Bank of India hikes the withdrawal limit for PMC bank account holders to 40,000 rupees from the earlier 25,000 rupees. And former captain of the Indian cricket team, Sourav Ganguly, has become the new president of the country's cricket board. He was elected unopposed. To my mind, frankly, that is arguably one of the best things that's happened for BCCI. Sourav Ganguly, the man who all of us followed very passionately, now heading that coveted position. Let's see what changes he brings about in Indian cricket. However, let's try and figure out what changes could happen at the stock markets today. Well, some happened to the US markets last night. They came off a little bit. And not unexpected, we were talking about this when the markets were shutting shop, that Europe was soft and US was likely to be soft. During our market closing hours, the news came out that China wanted some more round of negotiations before any probable trade deal. Now that led to the European markets and the US markets coming off. Asia is a mixed bag today. Nikkei was shut yesterday, remember? And this is what Europe did and what Asia is doing right now. Nikkei was shut yesterday, starts off about 1.5% odd higher. Hang Seng and Shanghai though starting off mildly lower. And keep in mind, I think something that we spoke about at least twice or thrice on the closing show yesterday is the reaction that the markets are now giving to Donald Trump's tweets and statements, simply because of the flip-flop that is happening between the two sides. And there's a chart, the Bloomberg chart that we'll pull up, which shows the kind of reaction that some of these statements are making. And a bit of a history, if you can just look at the chart to the right-hand side of the screen where the chart starts, it shows the heightened reaction that some of the Asian stocks showed every time US exhibited optimism or some inclination towards a trade deal. That has just started coming off in the last 2 or 3 odd months. And in yesterday's session was a prime example of Indian markets, for example, reacted very strongly at the start of the trading day to that. But by the end of the day, when the news came out that China wanted some more negotiations, the markets came off. So the relative movement of the Asian screens to what the US says about the trade deals is only coming off. And I reckon unless there is a definitive end to this, you probably see these reactions come off as well. SGX Nifty, though, for now, is showing an uptick of about 1/3%. Let's see if we start off that strong. Now, frankly, if you look at yesterday's session, while we came off and all, the advanced decline was still moderately okay. It didn't buckle down under too much of pressure. So the market breadth was neutral. But the point was that the indices closed just around the opening highs. They did not close well and truly above that. We started higher and we closed in and around the levels at which we started off. In technical parlance, that would have been slightly bearish. And if the weakness in the NBFCs, select NBFCs and the PSU banking stocks persist today, then it might have a bit of an impact on the market breadth in the session today. Remember, yesterday the PSU stocks came off quite rapidly in the second half of trade and fairly trader friendly as well. However, crude linked stocks might get impacted positively today simply because crude prices have come off. Now, I know that people will keep an eye out on inflation and try and think that, oh, inflation is inched higher and this is a problem. I don't think the RBI sounded too concerned about inflation, retail inflation pushing up as well. So even if it's much higher than or marginally higher than what the polls were, I don't think people will take notice of that having a bearing on what the RBI does. So that is out. But crude coming off about a couple of percentage points might have an impact on some of these stocks. What's to be watched out for today? Well, slew of results. I've highlighted 3 or 4 which I thought were the most important. Wipro, naturally so. Index company, ACC, not an index anymore, but an important stock nevertheless to watch out for. MCX, the reason I bring it up is because it's trading very, very close to its life highs, or 52-week highs, sorry, not life highs. But do watch out for this one. It's got a solid traction. And SBI Life, on account of what some of the insurance things have looked like in terms of the month of September and the stocks having come off yesterday, the results from SBI Life would be interesting to monitor as well. Analysts don't expect fireworks, frankly, from this one. We spoke to one yesterday from Investing. Didn't expect too many fireworks from SBI Life. However, in terms of stocks that could react today, HUL, now I don't know how much of a reaction it will bring, but just for people who missed this because it came out post-market hours yesterday, the results were in line with estimates. Volume growth was 5%. The estimated range was about 3 to 5%, so it's come at the higher end of the range, which is positive. Otherwise, the results were marginally above estimates or in line with estimates. Most brokerages have hiked target prices marginally post the results coming out. GDPL Hathway, the revenue growth was good and the media businesses clocked some strong growth. Numbers are not strictly comparable, but the stock was very active in trade yesterday. Let's see what it does in the session today. Fortis corrected about 4% after some bulk deals yesterday. Now we have the names of the buyers. One of the buyers is Eastspring Investments, which acquired about 40.5 lakh shares. Yes Bank was the seller. Let's see if Fortis manages to weather the storm today. Down 4% and crashed quite severely in the second half of trade. Let's see if he can manage to start off well today. And lastly, from a brokerage's perspective, Container Corporation of India I thought was an interesting one. HSBC has upgraded the stock to a buy from a reduced rating. The target price has been hiked to 675 from 450. The stock that has gone through some pain in the recent month. Let's see if there's some traction on the upside today. However, let's tell you what's lined up on First Story, the collection of the top editorial stories that we believe we should bring to you. What's aided Hindustan Unilever's earnings in the September quarter? Agam Vakili will tell us that. And what can we expect from cement makers in this earnings season? Nikki Mirchandani will bring us that piece. Next, Yatin Mota will get us the list of the 10 mid-cap stocks to watch in the second quarter. And lastly, Pallavi Nahata will tell us why consumer price inflation is at a 15-month high. Start off with the big earnings that came out post-market hours yesterday. Hindustan Unilever reported earnings in line with street estimates with lower input costs boosting margins. Agam joins us now to take us to the big takeaways from these numbers. Agam, you besieged with big companies, right? TCS, Infosys, HUL, today Wipro.
Yeah.
But okay, the first of the consumer companies, what did it show?
Well, it was actually, so we have that if it's 5% up and down, we say it's largely in line with estimates, but it's still slightly better than what we were working with. And this is something that analysts across have mentioned, that HUL has been resilient in a time when it's been very, very challenging. And that explains the kind of numbers. So let's start off with the numbers. And in terms of revenues, we're looking at around 6.5% increase and growth. Your EBIT has risen 21%. And that, of course, is the big surprise in the earnings. And consequently, we've seen margins improve also quite substantially to 24.8%. And profits, of course, rising around 21%. The reason why there may be a little bit of a disappointment profits is because corporate taxation also, the lower corporate tax also comes into play. But I'm going to come to that. First, let's talk about, the quarter in terms of volumes. Coming at around 5%, largely in line with expectations on the higher end of the range, actually. And moving on in terms of, several other factors. What we are keeping an eye on is price cuts. Price cuts have led volumes higher, specifically in the cleansing products. You also have fabric wash, which has led growth in, home care. Personal care, their largest segment, is where there have been price cuts, and that's the reason why the growth out there is about to the tune of around 5%. Beverages and ice creams have done very well in their foods business, and that's been driving, their gains. So as you can see, that's your segmental breakup. But personal care is the largest, but it has been significantly subdued, and of course, home care, along with foods, has been the big surprise here. But the big highlight of this particular quarter is the expansion in operating margins. They've seen 250 basis points expansion in gross margins on the back of benign input costs and improved product mix. And moreover, there are a whole host of other factors. Of course, improved product mix is something that they have been working on. And consequently, this has also had an impact on profitability. And let's not forget, lower corporate taxes means it's better for Hindustan Unilever. Of course, raw materials costs to revenues fall to 33%, again 36%. So a lot of these factors come into play, and that's the reason why, HUL has seen a little bit of a beat, if I can call it that, as far as this quarter goes.
Okay, just a couple of questions, Agam. One, did you make a lot of what they've done on the EBITDA and the gross margin?
Yeah.
Part one.
Yeah.
And part two of my question, they did mention that the quarter two or second half might show some recovery because of the government measures, so on and so forth. And I think I read the brokerage note from Merrill Lynch which said that the lower taxes will aid the EPS numbers as well.
Absolutely.
Is everybody sanguine about those two counts?
Yes, absolutely. First and foremost, the management has been very, very positive, and they are saying that despite the fact that we have had a challenging environment, we are good to go, we've sorted, and we have done much better. Their body language was very positive, which means that the second half, even if things may not improve, they are confident that they will be better than the rest of the markets. And on your taxation and profits, of course, is going to play out very well, and that's already evident in the earnings this time.
Margins performance heartening?
Absolutely. The considerable expansion of operating margins because of gross margins. Can they hold on to this? You never know, because the volatility in commodity costs is not up to them. They just have to react. And if the prices go up, they will eventually pass it on to consumers, as they have always done.
Yeah, but they are cutting down soap prices, so if you are, an HUL soap buyer, maybe there are some good times ahead for you. But Agam, thanks so much for putting that into perspective. That's the big company HUL, which came out with numbers last evening, and thankfully, a few people will say they've maintained the volume growth numbers that the street was working with. The markets need some good earnings, and we've got a decent set from HUL. Can we get the same thing from the cement space? ACC kicks off the earnings season for the cement companies today. While construction slowed down during monsoon, leading to a drop in demand, cheaper raw material prices may just provide a cushion in the second quarter. Nikki Mirchandani is here to take us through those details. Nikki, there is, I believe, very little cheer for the cement companies this quarter.
Right now, but things are not as bad as they're painted, Neeraj, because we got to bear in mind the fact that there have been easing pressures, which in turn may just offset the kind of subdued demand that we are otherwise seeing coming in from the realization, because of which the unitary performance might just look decent, at least for the pan-India players, at least on YOY basis. But then let's look at the volume performance of overall first the pan-India players before we get into the details of ACC. If you look at the volume growth figure out there, YOY basis, the numbers look subdued out there. We're looking at a 1.5% decline for ACC. Ambuja, it's a 3.5% downtick. Ultratech, it's relatively a growth out there, 5.7% kind of a growth figure. But if you look at that of a sequential performance, it's negative for all the players. Clearly, we're seeing more slowdown coming in from demand on account of slowdown in the execution of infra projects due to a variety of reasons. It is extended monsoons. Second, it's floods in certain areas. Then it's the festive season and lack of funds, essentially, which has been impacting the demand of the entire pack. Ultratech, on the other hand, is expected to see some amount of traction. That's also a trend which has been playing out from a couple of quarters now, due to strong volume growth thanks to the consolidation of Binani. So that's one bit, and also the fact that it's got presence across all the geographies is also helping Ultratech Cement clock that 5% kind of growth that we're expecting on YOY basis. But if you look at the unitary or the EBITDA per ton performance of these players, we're looking at least a kind of uptick coming in on the year-on-year basis. But then we're looking at a sharp drop on sequential basis. Two reasons: volume and realization. If you look at the cost-saving methods or the pressures, they are seeing substantially easing off only on YOY basis as compared to sequential basis. That's why you're seeing that kind of uptick there. But if you're just supposed to look into the ACC's performance...
because that's the one that is coming out with numbers. So what is, or will the lower costs work for ACC this quarter, Nikki?
That's what we're expecting, at least EBITDA per ton performance. That's what the expectations are. But then I'm going to, first throw up the basic numbers first, where top line growth, we are expecting a 4.3% uptick there at a number of around 3,508 crore. EBITDA, we're expecting a 14% growth. Margins are expected to expand to 14% as compared to what we saw in the corresponding quarter. That's 13%. Essentially, the key matrix, volumes 1.5 5% downtick, almost flattish out there. Realization, however, we're expecting a 6% growth. That is expected to aid the unitary performance. That's the EBITDA per ton. We are expecting a 15.3% performance out there. You know, in this quarter, if we talk about the easing pressures, Neeraj, it's the domestic pet coke prices essentially, which has fallen by as much as 16% year-on-year basis. Diesel price, they've come down by 6%. That is expected to weigh on. That's expected to aid the freight cost of the companies. A combination of this is expected to aid the operational performance of most of the cement companies.
Numbers likely post-market hours?
Yeah, we're expecting somewhere in between. Not sure about the second half, maybe.
Okay, second half. Definitely not the first half. Maybe during market hours, maybe post that. We'll wait and watch. Nikki, thanks so much for putting that into perspective. That's ACC will kickstart the earnings season for the cement companies. Not expected to be a great season any which ways, but important one simply because some of the stocks have corrected quite a bit. Blame it on the weak economy or otherwise. Actually, speaking of the weak economy, that's likely to reflect in corporate earnings this season by and far. But there are some mid-cap names that are expected to stand out in terms of the margin performance. Yatin Mota is standing by with the mid-cap stocks to watch out for in the second quarter. And Yatin, I normally say this after the piece is done. I'm saying before because people should log in and try and read that piece on BloombergQuint.com. But which are the companies that are standing out? Why and what is the selection criteria that you've used?
So, Neeraj, more importantly, the selection criteria. Usually in the large cap companies, we do have a lot of analyst coverage, but the mid cap end of the market where the coverage is less, the focus is less. We have tried to get those companies out which will have some big or small blip as far as their operating performance is concerned. The selection criteria that we have done is market capitalization should be below 15,000 crores and the stock should be covered with 10 analysts so that we get accurate estimates. As far as the overall top 5 companies are concerned, which are likely to report a strong expansion as far as their operating performance and operating margins are concerned, are the likes of Orient Cement. We also have PVR, which will do well. As far as print media companies are concerned, they will also report some strong margin expansion. Let's first talk about Orient Cement, which is expected to see almost 7.5% plus kind of a improvement in their operating margins. This is on the back of the modest volume growth and with the monsoon ebbing, probably the higher cement prices are likely to aid the overall profitability for Orient Cement. Of course, this is on a lower base. PVR, remember there have been some successful box office collection during the quarter. We had the consolidation of SPS Cinemas as well as strong growth in the food and beverage segment, which will be aiding the overall margins for PVR, which are expected to be higher by about 6 percentage points on a year-on-year basis. As far as Gujarat Gas is concerned, again here we have seen that the spot LNG prices have seen a 57% drop. More importantly, there has been a higher volume growth for the Gujarat Gas entity during the quarter, which is expected, and on the back of that we could see some good margin expansion. Also watch out for the entire print media pack because analysts are anticipating that both DB Corp as well as Jagran should report strong expansion in their margins. This will be largely due to the fact that there has been a 30% drop in the newsprint prices, and on the back of that we could see some good margin expansion. As far as the laggards are concerned, the companies that could see a margin fall on a year-on-year basis, we start with SAIL. Remember, this PSU has been under pressure on the back of lower steel prices, and more importantly, not only the steel prices are lower, the steel spreads are also lower. This is basically a differential between the spot steel prices as well as the cost of raw materials. Despite the fall in steel prices, we haven't seen much of a fall in coke prices as well as iron ore prices, and that clearly have been putting pressure as far as the entire steel pack is concerned, and SAIL is most likely to get impacted the most, and they could see almost a 9.5% drop in their overall margin this time. SKF India, we very well know the auto slowdown as well as the export slowdown. Probably both of these factors would be eating into the margins for SKF India, which are expected to be lower by nearly 7.5% plus on a year-on-year basis. Also watch out for pharma majors. Both Glenmark as well as Alembic are likely to see price erosion in the US market, and also during the quarter we couldn't see much of a new launch coming in as far as US markets are concerned. So both Glenmark as well as Alembic on a higher base could see some volatility in their US markets, which will translate into lower margins. And finally, KNR Construction is also one infra name to watch out for. Remember, this is a monsoon quarter. Construction activity is any which way is low. Plus, KNR has recently lost out on a lot of irrigation projects, and typically irrigation projects for KNR were high margin business segments. And probably because of these one or two factors, KNR is also expected to report a decline of nearly 5 percentage points in terms of operating margins this quarter.
Just wondering, Yatin, a follow-up, companies like, say, for example, PVR in the exhibition space, because what's worked for PVR might work for Inox as well. And similarly, Gujarat Gas, the margin boost that has come in could probably come for the other companies as well?
Not necessarily, Neeraj. So let's talk about PVR first. There is a consolidation of SBI Cinemas. More importantly, the share of PVR in terms of food and beverages is much better than other peer sets, including Inox Leisure. So it might not be, of course, it does, to a certain extent benefit the entire industry. But the kind of operating leverage PVR has in terms of these two, sub-segments probably would translate into better margins. Which was your second company you said?
Gujarat Gas.
Gujarat Gas, yeah. So I was speaking to Swamit. Not necessarily again for Gujarat Gas, it applies to the entire gas pack, because a lot of companies do have a pass-through clause. Gujarat Gas, the volumes in the Gujarat region, the industrial area, and the kind of penetration that they have in newer areas probably will lead to better volumes. And gas is usually a volume play. IGL, of course, has done really well as a stock, probably reflecting that the quarterly earnings would be better, but probably wouldn't be as same to probably a Gas Authority of India, which has a different cost structure and different gas pass-through arrangement to Gujarat Gas, which is a privately owned company.
Well, gas companies are certainly in focus yesterday. Adani Gas and Total and the deal that they did. So essentially oil and gas-related themes pretty active. And watch out for SAIL. I think the margin hit that SAIL will take because of lower steel spreads. You'd probably reckon, maybe not in the same vein, but some of the other steel companies could also have similar hits being taken. Yatin, thanks so much for putting this into perspective. So 10 names that you got to watch out for this earnings season based on the kind of performance on the EBITDA front that these companies could show. Well, on to some macro data, and that's the last piece on First Word today. While wholesale inflation fell to a 3-year low on Monday, retail inflation came in at a 15-month high. The 3.99% figure for September was the highest since July 2018. Pallavi Nahata takes us through the details in the report.
Retail inflation rose to 3.99% in September compared to 3.21% in August, according to data from the Statistics Ministry, which was released on Monday. A Bloomberg poll of 37 economists had estimated inflation at 3.8% for September. The pickup was led mostly by food prices. At 4.7%, inflation in food and beverages rose to the highest since December 2017 as rainfall distribution skewed agricultural trends across the country. Vegetable prices rose by 15.4%, contributing the most to the rise in inflation. Rural inflation rose to 3.2% in September as against 2.2% in August. Inflation in urban areas stood at 4.8% compared to 4.5% in the previous month. Core inflation, which excludes food and fuel, continued to moderate, indicating weak demand. At 3.99%, core inflation was the lowest since July 2017. Rise in CPI has been contrary to the continued fall in wholesale inflation. WPI data released earlier on Monday showed that WPI continued to decline, falling to 0.33% from 1.08% in August, led by a fall in fuel costs and prices of manufactured items, which saw contraction.
Well, that's on the inflation data as well. I still believe, though, that these numbers might not be the ones that will shake the market belief that the Reserve Bank of India is on a rate-cutting trajectory. Not so alarmingly high that it will alter what the MPC's statements and the MPC's actions were in the meeting gone by, and the commentary, of course, that they gave. Remember, the RBI is no longer just an inflation targeting bank, but they're also focused on growth. So doubt that these numbers really alter that piece. Okay, that's all that we have on First Word today, though, but lots more lined up on Indian Open and the rest of the show. Pramod Gubbi of Marcellus Investment Managers joins in to try and talk about whether they're still sticking to quality or they're trying to look at some other factors beyond. Get a sense of how the agriculture sector might be faring after the delayed but heavy monsoon with Abhijit saying would crop prices move up. We have that special conversation at 9:30. And then see how DLF's new launches are faring in the festive season with Akash Ori, Senior ED Marketing and Sales at DLF. But after this break, a full tilt towards the day's trade.